Greetings and welcome to Heli Market Trends Live, hosted by Aero Asset. I'm Emmanuel Dupuy, and delighted to welcome you to this roundtable dedicated to global helicopter leasing, a segment of our industry that continues to evolve and grow. We'll have two panels today, the very first of which is led by Ed Washecka, CEO of Intrinsic Aviation. Hello, Ed.
Hello. Nice to see you again.
Nice to see you as well. You've been involved in our industry for a long while now, from Secor Holdings to Era Helicopters to Waypoint Leasing, and most recently Intrinsic Aviation. You've experienced boom and bust cycles firsthand. I think no one disagrees the aviation market is, in general, cyclical. Certainly the helicopter segment is no exception to that. And I'm sure that will be one of the many topics that you will explore in your panel. Therefore, without further ado, please go ahead and introduce your speakers.
Thank you. Well, welcome everybody. Good to see you all here. So we have Marc Schechter. It's a little bit of a Waypoint alumni session. Marc Schechter from ITE Management, Clark McGinn from Uplifting Aviation, and Oliver Althoff from Seabury. And if you guys would, I feel everybody kind of knows you, but like, why don't you just take two seconds, 10 seconds?
Sure. I'll start. As Ed said, I'm Marc Schechter. Ed and I were in the helicopter industry together some 15 years ago at Secor and Era. I joined Ed at Waypoint.
You forgot the name.
Yeah.
And it's so painful to remember.
And was then briefly with Macquarie, Thora, and now ITE. So I am a proverbial carpetbagger in the helicopter financing and leasing space.
Clark?
Hi, Ed. Good afternoon, everybody. I'm Clark McGinn. I started in helicopters in 2002 at Royal Bank of Scotland, then moved to CHC to build its internal leasing hub in Dublin. Then Ed kindly asked me to join Waypoint, which, as they say, seemed like a very good idea at the time. And after the fun at Waypoint, I set up my own consulting, uplifting advice, and I advise typically investors, often fixed-wing investors, looking at the rotary market. Over to Oliver.
Yes, good morning and good afternoon, everyone. Oliver Althoff, I'm a managing director at Seabury Corporate Finance and lead our specialty aviation, aerospace, and defense investment banking practice. I've been in the corporate and investment banking practice before Seabury, and have funded at least both lessors and operators on the helicopter side since 2011. Was at Waypoint, ran capital markets and treasury, and have been now at Seabury for the past 6 months. We are about 70% M&A, and that's both sell side and buy side, and 30% of what we do is capital raises from senior debt on down to non-control equity and structured equity. So great to see everyone.
Thank you. Well, so all of us have been in this space from before there was enough interest to actually have a helicopter leasing market trends roundtable, and now we have enough interest that they happen every so many months. Anyway, so with that, and I'm gonna let you guys kind of jump in, but like, how are you guys sort of seeing the market today?
I'll start as the one that's probably closest to active helicopter leasing. We've seen an incredibly robust helicopter market generally for a very long time now. It kind of has been surprising to some people that look at the cycles, the previous cycles over the last decade or decade and a half, and you look at, let's say, the last 5 years, pretty much since COVID, that there really has been a steady period of growth. There has not been any substantial downturns in any of the cyclical industries that kind of drive helicopter demand, and most significantly, the oil and gas market has really been for lack of a better word, resilient. Even as we've seen some pricing softening in the oil and gas market, and oil specifically, in the last 12 to 18 months, the helicopter market has not experienced any significant decline in demand because of those changes. In fact, in some markets, we continue to see a significant uptake in activity.
So if I can just, so pick on you then a bit. So you got a new investor who's come in and bought, your last company, and so that's sort of new capital in the space, but it's replacing, existing capital. With the fact that the market's doing so well, and we have seen other lessors launch or folks say they want to sort of get into the business, are we in danger of froth again? And how do you and other lessors protect against that?
So ITE, where the shop that I've been with now for 6 months, and just for those who don't know, ITE acquired Thora Capital earlier in 2025, and Thora had been extant for 7 years before, but really very much a bit player, a niche player in what is a niche market. Helicopter leasing is a niche market, and Thora was a niche player. And I think that is a significant reason why Thora and now ITE continue to see success in this market. We haven't, both firms' strategies has eschewed the areas of the market that could become frothiest. And that would, in my view, that's heavy equipment that services the oil and gas industry. That while I wouldn't say that it is a frothy market today, that is the place where I would say there is the most risk for frothiness.
All right. Well, so
and I think you should take up. Maybe you should ask Clark.
I was going to say, if there's someone here to talk about froth, it's Clark.
Yeah, and talking of froth, I'll blow it off the top of my pint and put it over to the side so you can't see me drinking when I'm talking about this. I think Marc's touched on some good points there. The underpinning that prevents the froth is the discipline the OEMs have. And we've heard it from each of Airbus, Bell, Leonardo, Sikorsky, slightly different stories in each time, but they're not running to ramp up production. They're going to keep it steady. So that leaves, where could froth be? There's one relatively new lessor with a speculative order book. They seem to be managing it well, but there's an element of risk there. And there's also the big THC orders that go through Saudi Arabia. And we've seen a couple of items coming out through Rotorcraft, which again could be a sign of exuberance. But it's relatively small in terms of the mega orders that were there 10, 15 years ago, which effectively duplicated everything that the operators wanted. So I think, if everyone's rational, then at this point, there's very little sign of froth.
Maybe a little bit, not to be too controversial here, and curious to hear both Clark's and Marc's opinion on this, but there've been a lot of lease rate increases upon renewals, right, including for older kit, which is great in terms of return on capital being more appropriate or good. For the leasing community, we see debt providers coming back to the market. But are we at a point where two questions: have the operators' underlying rates moved up sufficiently to be able to support that? And two, what is happening with the better credits? We're, for example, hearing from the better credit on the operator side that those that have had a 50-50 owned leased strategy are contemplating, and some are actively enacting, moving to a 70% owned, 30% lease strategy, because for a 7+-year-old H145, if lease rates are increasing 20-25 grand, some of them that have more abilities to potentially attract well-priced debt are thinking twice as to whether or not they can swallow such an increase.
Well, is part of that, in terms of lease rates, right? Some of that is going to be because of supply. Like, I mean, if I own the asset and I'm the lessor and somebody wants it, I'm going to look to sort of maximize my rate. And someone that may have the wherewithal to go buy the asset still needs to acquire it. So that there's, that issue sort of front and center. But
the question is on the lease contracts, and again, are there today early buyout options? Are there end of lease fair market value options to acquire? If all of those have been eliminated, right, then an operator would have to go through the secondary market, including maybe through Emmanuel and Will and the team to acquire those assets, or place new orders, of course. But Marc, Clark, I don't know what you guys are seeing.
Yeah, I think it's a bit of both, really. If you can access, stepping back, one thing, one of the other reasons there's no froth in the market is because there's still relatively little bank debt available, particularly in the oil and gas side, to support helicopter leasing. So that means, as the lease rates rise, as Oliver rightly says, they're of course lagging the interest rate rises from 1% to 5%. So we're only catching that up, and we've been catching that up at a time where there's been no supply, and we've seen tightness. So basically, the 92s, the super mediums, the 139s are all at round about 100% capacity. So everyone's paying their way there. I think the important part is the change in terms and conditions that we're seeing through the oil majors, where in the old days, before the crash, the majority would be paid on the fixed monthly payment, the monthly standing charge, and a smaller amount on flying hours, a variable amount. In the downturn, the oil majors turned that on its head, and we're seeing that come back towards heavier monthly standing charges, which does permit more use of the lease product, because you're guaranteed income and you understand your expense. But I think Oliver's main point is that where we are in the cycle, a top-notch operator can raise funds and manage its own depreciation policy in probably what is definitely a cheaper way than a mainstream lease.
If we stick on the debt for just a bit, and Oliver, I'm going to ask you this question in a second, but so there was a headline recently about Air Methods trying to do a quite large $1 billion plus bond deal that got pulled. I don't know the terms on it. Do you think, with respect to finance, and there was an article today I was reading about debt financing and coming back for M&A deals. So what would it have been like for buyers of LCI if they had been trying to raise bank debt, right? If that transaction was not to SMFL,
it wouldn't have happened.
Well, that transaction was actually stapled by the seller. So you had financing at at reasonably attractive terms. On a secured basis, you were able to get financing done. I think there's a couple of things that have happened. One, LTVs are lower. We used to be at 75% of the current market value, maintenance adjusted, of course, by either one or a couple of the appraisers. That may still be possible today on long-term SAR contracts to really good counterparties. But within the oil and gas segment, funds have come back. But we are talking about, at the bottom, 55%, at the top end, 65% of loan to value. And that is de-risking based on the experience in, 2015 through 2018 by the lending parties. Price points from a margin perspective are also 50 to 100 basis points higher. So you've got these dual effects of a lower advance rate plus a slightly higher rate, but people have come back into the market. I would say that for financings roundabout 100 to 200 to 250 million, that's probably where you get to a point of having a challenge to get enough of a syndicate together. But at those kind of levels, that's a lot easier to do than trying to do a $500 million or $1 billion transaction. And I think, don't know the specifics about the Air Methods transaction, but you obviously have the backdrop of what Marc and I and others discussed on a panel a year and a half ago about the No Surprise Act and what happened in terms of the restructuring needs on the medical side on the EMS side within the North American sector.
Marc, do you have any comments on that?
Yeah. So let me just give some experience that we've had at ITE. So we completed a $150 million warehouse credit facility earlier this year. The pricing is actually a little more attractive than Oliver is suggesting. And we've seen that certainly on an LTV basis, there have been some drift from the 50% that Oliver is speaking about, which was common in financing we were doing 18 to 24 months ago. But we're seeing a weighted average LTV now closer to 65%.
Yeah. That's what I'm saying.
So there has been improvement for us on the LTV basis, and on pricing. We've also been able to narrow pricing. Some of that is because of the IT relationship that the Thora team is now able to benefit from.
Yeah.
But I think there is as time passes, there is increasing comfort with the space, right? As the trouble that we all experienced acutely, fades further into the past. Banks have short institutional memories. The people that we are working with today are not people that were there 10 years ago. So there is a refreshing of the people at these banks, and we're able to bring a new a different go to market or go to the bank position when we were speaking with them.
Yeah, and let's not forget the super strong management team.
Yeah.
Yes.
Okay.
It's also interesting to know, Ed, that there have been a couple of export credit deals done in the last 18 months, which again shows the gap between the two, the availability of commercial funds, because export credit's a great idea, but it is burdensome in a number of ways. But yeah, it's eminently doable. But that, I think, indicates that as Oliver was saying, there's not a lot of big ticket money out there ready to deploy at the top of the hat. And yeah, we've seen that in some of the M&As, a public listing last year that didn't come off, the Air Methods bond deal. Yeah, it seems very hard to get the big numbers together.
Yeah. What about, I want to specifically with financing, but so we hit on oil and gas and the difficulty there, and the recent issue with no surprises for Air Methods, but traditionally, like Oliver, when you and I were out looking at financing, there were certain sectors that were really popular, EMS being one. But what do you see now in the more sort of specialty use assets? So whether it's more off the run in terms of older stuff, smaller value, there's some rumor about Columbia being in the market with, again, those kind of more specialty assets. Like how do things look for those kinds of assets as opposed to the more bread and butter new newer H135, 145, 139s?
There is a market, and financing is getting done in those markets. I think it depends on the underlying contracts and cash flow being generated. So for example, there's there's some specialty assets out there in terms of what Heli Express has now built with the Ericsson Sky Cranes, and they acquired Schechter as well, right? And so significantly grown that business. So you have a certain asset backing, but you also have a certain contract and cash flow underlying that. What happens in some of the assets that are very specialized is that it's a non-bank market. So you end up paying perhaps a higher rate compared to the liquid, highly liquid assets, from Leonardo, Airbus, and Bell, and some of the Sikorsky products as well. So there is financing that can get done. But I think the lower rates, so the rates that I was referring to, which we are seeing sort of in a 250, 275 margin to 350, 375 margin context, that happens with the liquid assets, the assets that are part of the leasing portfolios, that you would ordinarily see, and where Emmanuel and Will and the team have created a lot of trades, and there's a lot of changing of hands of assets that they facilitated as well.
Okay. And if maybe one more thing I want to ask you guys. So when we look at the consolidation that's happened, so now two big lessors, and Marc's in there with his niche, and maybe will get bigger. And there's the Michael York's group that's launched. There was speculation with THC that they would be getting into the leasing business in a significant way. Like, does the world benefit from or need, another big leasing company? Is there appetite for it, whether from banks to support it, investors to sponsor the equity? Obviously, there's infrastructure funds that have kind of gotten into the space. I recognize you guys all may have a little bit of bias in sort of your answer, but if you could just sort of, I don't know, think about it, and how would you address it?
I think what we've seen in 25, 30 years in the helicopter market generally is that a good balanced competition model in a region or a sector is two big guys and a swing. Yeah, and we're reaching here in the lessor market. That swing can be different. You've got ITE, other sort of specialist investors coming in. You've obviously got Olivier and Nova. You've got Arias out there. You've got a couple of other specialities coming in. They keep the two big guys fair and square. So I think that's good. Whereas you compare the UK's North Sea market and the mess that the Competition and Markets Authorities made in forcing CHC to sell the Babcock assets, that's a weaker market all round, both in terms of lessor appetite and bank appetite, and unfortunately, it's beginning to hit even on the ground in terms of jobs. So, I think the leasing market has done well by getting to this point, but open to contrary opinions.
I think right now there are players in the space that think they can become the next big guy. I do think that after the recent consolidation, the changing of hands of Milestone, and the consolidation of LCI and Macquarie, that there are some players in the market that we've talked about already that are viewing this consolidation as an opportunity to grow big. IT is not one of those parties. We intend to continue to be a niche player in a niche market, selecting specific assets, going after specific lessees that, frankly, most of the rest of the market hasn't reached out to in the past. But I do think somebody else. I think in the next 12 to 18 months, we are going to see overtures by some of these other parties to be bigger. And how it plays out is to be determined.
I think what's happening is overall in the market is not too dissimilar. It just lags by quite some time the fixed wing aviation market, right? In that, what are the plays in which people are making money there, and what is the equity and equity cost of capital? So there's consolidation, which can have SG&A and other synergies, and just get certain better pricing through scale. So the SMFL LCI, acquisition of Macquarie Rotorcraft is a similar story there. You have Chinese money backing lessor, Middle Eastern money potentially, right? These are all plays, and we see this like in the fixed wing world. BOC, Bank of China, accepts an 8 to 10% levered return. You saw AirCap acquiring GCAS. SMBC Aviation did another recent acquisition. So they're getting either big, or you have cost of funds advantages, certain Japanese money, Chinese money, Middle Eastern money, or you stay niche, like IT is doing, where they are focusing on particular situations that give them a great risk-adjusted return, where you're not competing on scale or low cost of equity funds. Although I hope, Marc, for you and Russell, that I would imagine with the IT combination that you've got some benefit on that front now as well. But that's sort of, I think, a general evolution right now in aviation leasing.
But do you think, Oliver, that equity investors in the helicopter space are going to accept single-digit returns? No, absolutely not. But you've got an evolution where in that market you've got new narrow body leasing by new guys at 8 to 10% return. Then you've got midlife leasing at 11 to 14% return, and stub lease to part out. And I think part out is going to come more at the helicopter segment at some point as well. I know, Ed, you've done some work in that, but I think with supply chain constraints, parts availability, and all of those, we're seeing that can happen with stub lease, end of life leasing. They're at 15 to 18% return. So that's sort of the spectrum. One of the things that we're seeing that's interesting, including in the helicopter segment, but also in some related aviation segment, is infrastructure money coming in. Infrastructure used to be toll roads, cell towers, airports with concessions. We're seeing that they have now a core plus and then an opportunistic strategy, where the opportunistic strategy at their high end of yield requirements starts to overlap the private equity model. And that's just because they've raised a ton of money, and so they're expanding what they can invest in. Yeah,
but I think, helicopters are not toll roads. Like, I think there was a period where the old Bristow made an attempt at really convincing the world that they were an infrastructure play. And it worked until it didn't. So
we know, because on some of the M&A that's going on for operators, the infrastructure funds are involved. Now they're doing that at the mid-teens return requirement, right? So that's in their kind of core plus opportunistic level, not at the traditional infra level. But what do they want? If they've got hard asset and underlying contracted business, that's the two ingredients for those strategies for them.
Yeah, and oil and gas was great underlying contracted business until the contracts were canceled for convenience. So,
right.
Anyway, Clark, were you going to say something?
I was just going to say, one of the problems we've always found with the infrastructure funds and helicopters is just the scale and size of deals. RBS, at CHC, at Waypoint, we had lots of discussions. Yes, some deals happen, but many just fall by the way because of the size and complexity.
All right. Well, look, unless anybody else wants to add anything. I'm going to thank you guys all for participating and wish you all a very happy and healthy New Year.
Yeah.
Back to you, Emmanuel.
Thanks, Ed. Thanks very much. And look forward to blowing the froth of some mutually drunk pints in the very near future with all of you. Ed, and your Waypoint alumni members, Clark, Oliver, and Marc, thank you so much for articulating the real state of the helicopter leasing market, like beyond the headlines. And I'm now very pleased to introduce John Heskin, who is Managing Director, Head of Aerospace, Defense and Government Services at East West Bank, and Russel Christopher, Head of Helicopter Origination, Sourcing, Disposition, and Execution at IT Management. Hello, gentlemen.
Hello.
Hello. Nice to see you both. I mean, I can't go over your respective bios in detail. Your resumes are like a director's cut with a ton of bonus scenes. But basically, John, you're a seasoned finance executive with 28 plus years in lending across major platforms, including CIT Bank, G Capital, Bank One, Private Credit. And Russell, you're a veteran aviation investor with 25 plus years in aircraft origination, leasing, and private equity leadership. I hope that was a fair sum up.
32 years. But who's counting? Stop it.
John, I don't think we've ever met in person, so I will do you the honors and start with you if that's all right. You've recently joined East West Bank, so can you please introduce the bank and tell us the differentiators?
Yeah, and thanks for the opportunity to be on. Just the one thing about the bio is that I started looking at doing helicopter transactions, I think around 2011. So it's been quite some time, quite a ride up and down a little bit. But I think I have significant experience with structuring warehouse transactions and even just discrete term loan transactions in the market. So yeah, I just joined East West Bank 7 days ago, and for people that have never heard of this, East West just launched its Aerospace, Defense, and Government Services group, which they tapped me to lead. East West is about an $80+ billion in asset bank with over 100 branches nationwide, including a few in Asia as well. And what we're doing is we're offering senior secured transactions, both on an enterprise value basis, primarily focusing on supporting private equity purchase of companies in the sector, as well as ABLs and asset-backed transactions. And on the asset-backed transactions, our focus is on aviation assets. So it's about mid-life aircraft, helicopters, engines, and spare parts. And it's great to be here. That was my little commercial. I hope to continue talking.
Thanks, John. Russ, so IT recently purchased Door Capital. You were a partner in that company, so you had a front row seat to it all, and you still have a front row seat to it now. And so I'm wondering, like, how IT enhances performance, versus how things were going at Thora.
Well, it's night and day, really. I mean, primarily and most obviously is the amount of capital we have access to now. We're drawing from a diversified transportation fund, which is very significant in size. Far more than we could ever deploy into the helicopter space, because as they alluded to in the first panel, there's a limit to how many lessors you can have, and there's a limit to how many transactions are available. In fact, actually, if you don't mind, I made a couple of notes here earlier because you've asked me to think about the macro market condition, and they touched on it in the first panel. But if you consider the commercial helicopter market in terms of oil and gas, EMS, fire, utility, the sort of core commercial missions that we generally all focus on. That, based on aggregated sources that I was looking at earlier, valued at about 6.8 to 7.5 billion in 2025, with a projected CAGR of 5 to 6% a year through to 2035. So they're projecting about a growth to about 10 billion in market value. You compare that to commercial aircraft market, it's obviously not that significant, and it's well catered for with the existing lessors and the capital that's available. Post-pandemic, the recovery has been in sort of essential missions, the mission critical verticals, which we mostly focus on anyway. And there's OEM production backlog. I think it was Clark was talking about how the OEMs are quite disciplined in their manufacturing output. I think the sort of the limitation on production rates and some sort of geopolitical disruptions generally around the world, I think the general effect that's had on the market is I think there's been a bit of a compression in transaction volume in 24, 25, but that's also kind of held prices up. So prices and lease rates have generally held firm or gone up or increased, but transaction volume has been continued to be limited. So, that's a very broad brush view I see of the market. I think I'll stop there for a second.
Yeah, John, do you want to chime in on that and kind of give us your macro viewpoint as well?
In terms of I think following Russell's comments as well as Oliver's, the market is completely different than it was 10 years ago, even 5 years ago. In terms of, I'll speak from a debt perspective in terms of what kind of available transactions are out there, and there's been a lot of consolidation. Before when Waypoint was around, it was Milestone, Waypoint, LCI. And lenders were attracted to the market based on bigger transaction sizes. It takes a little bit of time to understand this market, and I think that point in time there was enough of a carrot to spend time understanding what's going on and build up teams that serially do these kind of transactions. But I agree. I think that there's a lot lower transaction volume in the sector. There's a lot fewer lenders in the sector, but I think we're supply and demand have to meet at some point all the time, right? So long way of saying this, I think if there's more opportunities out there, I think there'll be more lending opportunities as well.
So are you
also just one last comment about industry stability, right? I think a lot of people got chased away a little bit from the disruption that we've seen in oil and gas, and as that stabilized, as the supply and demand stabilized in that particular sector, I think people are starting to come back and have an appetite to consider new things.
So are you looking at sort of analyzing deals like new transactions differently today than 10 years ago?
Yeah, and I think, part of this panel is really comparing and contrasting, I think, bank lending versus private credit. But to answer your question just about, bank lending now versus bank lending before, I would say no. I would say it's the same approach, I think, but the outcomes could be a little bit different. The structuring could be a little bit different. For example, there are certain minimum requirements to do a bank deal, right? Years in business, certain revenue size. In the case of helicopter space, certain fleet size, for example. What's important to I would call a regulated bank, first and foremost, is cash flow. That's what we look at. So it's really quality of lessee as a primary source of repayment. And then we look at industry. Is there stability within this industry? And then assets, right? Are they liquid? Can you, if you end up having to repossess an aircraft, can can you dispose of it relatively quickly? Can you sell it for a price that's above your principal value? And as it relates to private credit could be also a source of repayment to a bank loan, right? For example, certain things don't fit, or the financial metrics of a deal might slip past what we're comfortable with, and private credit's there kind of to take over and to support that particular transaction. So I would say the credit fundamentals are the same, but I think going back to some of the points that I think Marc was mentioning and Oliver as well about the loan to values, those have come down. Obviously, those have come down a bit, and then you have certain loan to value structures in different industry types, like oil and gas will attract a lower loan to value, fire support, air ambulance higher. So it really depends. There's a bunch of nuances, geography, type of aircraft, age of aircraft, and then of course quality of lessee. Quality of lessee, I would say, is one of the most important things we look at.
Do you think we'll ever see the day, sort of like in 07, 08, where banks will extend 100% financing, non-recourse? Is that going to happen again?
Well, I mean, that's happening to a degree in the fixed wing market, right? There's a lot of the large lessors are unsecured, quasi unsecured, right? There's little kind of covenants kind of backing things up in terms of their ability to pledge, assets as collateral for other transactions. So there's a kind of backdoor way of getting to asset coverage. But I think it's few and far between. It's the investment grade credits, sure, that might happen. But as it relates to the smaller players, that I don't see that happening anytime soon.
Russ, how does your approach compare? Approaching and analyzing new transactions. So from the prism of the private equity asset management.
Yeah. So I mean, John and I were going to be underwriting deals following a very similar process of analyzing credit and metal and the situation of the operator in its market. But I was thinking about this earlier and trying to sum up what's the key differences between regulated bank versus a private credit lender / lessor. And I came up with this more succinct view, which is a bank such as John's is solving, for a strict credit writing policy to a fixed margin. And I know his margin can vary slightly, but not in the way that ours can. Whereas in equity, we're solving for a maximized return, which is risk adjusted to the deal we're looking at. And we're trying to mitigate all the risks, but solve for a maximum return. So, John's trying to adhere to a strict underwriting policy with a credit focused drive, whereas we might be dealing, for example, with credits that might not pass muster at a bank, but we're looking at other aspects of the deal. We're mitigating the risks to the best of our ability, but we're pricing the deal according to the risk. And I've said this before, and I'm probably repeating myself from other seminars like this, but banks, they're looking back at historical credit performance to try and see a story and look forward, whereas we can work with companies that might be a startup or not have a good recent credit history because of a pandemic or a bankruptcy or something, but we can look at who the team is, what their market occupation is, what the metal is, and what the story is going forward, and we can take a view looking forward and take a risk, and again, price the deal accordingly. So I think those are the key differences.
Yeah. So what deals are you targeting, specifically?
Well, under our new management and access to capital, it's broadened somewhat because, as Thora, we had a certain amount of capital available, so we would be more selective about what deals we do, and we were trying to find, obviously, the best deals. Now we're now looking at kind of more typical kind of legacy Thora deals, anything from much smaller onesie twosie deals that are unlevered with a higher lease rate factor with smaller businesses or more challenging credit, through to somewhat more vanilla deals on a larger scale. We're also broadening into fixed wing through the turboprops that are doing similar mission critical missions, as such that, you know, there's a crossover between turboprops, corporate jets, and helicopters. Where we've looked at fixed wing EMS deals. We've looked at a handful of those. We're looking at one now. We've done turboprops on mission critical services to sovereign entities. We're looking across the whole gambit, just not into the commercial aircraft market, because ITE actually has a commercial aircraft vertical. So we obviously share data there, but it's quite a broad brush.
John, what kind of deals are you targeting?
Yeah, I guess I have a fairly broad mandate in terms of the end markets, being aerospace, defense, and government. As well on the asset side, the mandate is fairly large. That encompasses, as I mentioned earlier, mid-lift aircraft, engines, spare parts, helicopters. So always doing those things. As it relates to helicopters, I would have loved to do the ITE, $150 million transaction, but that I was in private credit at that point, so that wasn't available to me. But deals like that are certainly of interest, and I do have experience running those transactions. But as I mentioned earlier, that there's just not, I would say, a tremendous amount of volume in the space, and so I'll be looking at transactions that start at around 10 million on the asset side, so 10 to 75 million in terms of deal size. Of course, open to doing bigger transactions with partners at that point. Above 75, would likely have to bring in some club lenders and things like that. But also I think flexible in terms of the structures. I would say nothing's really plain vanilla when it comes to asset finance, and so I'm open to clever, unique structures that might come up and ways to solve kind of mitigate issues with credit enhancements, etc. But yeah, in terms of that, like I said, deal size 10 to 75, but in really broad range of assets.
Okay. What's your outlook on debt pricing, like over the near term? Maybe assuming a 5-year weighted average horizon?
Yeah, so there's two components of pricing, right? One is the SOFR rate, which is the replacement of LIBOR a couple years ago. And then there's the credit spread, right? And the credit spread is determined by the credit risk involved, right? So that's going to be nuanced by credit quality of the end user. Is there a guarantee involved? What kind of asset it is? What kind of advance rate? If you go higher advance rate, there could be a trade-off with higher pricing, and things like that. The SOFR component, I think SOFR right now is at 3.9% is the SOFR rate today. There has been a lot of volatility in interest rates. I think there's potentially a rate cut today. Actually, I don't know if it happened all around this webinar or not, but if you look forward, so I'm in no way an expert on rates, and please no one rely on this, but if just looking at public information, you can see that the forward for 5 years from now is a little bit, I think it's expected to be 3.6% in 5 years exactly. But the best way to look at it is a swap rate. So the swap rate is, I think, 3.5%. So the expectations of the curve are slight decreases over the next, I would call it 12 to 18 months, and then kind of returning back to the levels we're at today. That's the current expectation, but that changes quite dramatically based on what the Fed does, just what the general economic conditions, labor, inflation, world conflicts, everything impacts interest rates. So again, I think the credit The credit spread, I forgot if I mentioned this, but what I'd be looking at in terms of my credit spread is starting at 250, SOFR plus 250, probably topping out at 500 for asset deals. And again, it's all based on the structure. So if there's it's a very conservative structure, everything lines up, lower rate. If there's a bit of a challenge, maybe a small story involved, a little bit higher. Liquidity of assets, all kind of ranges in between there.
Okay. I've got one for Russ, and then I've got a crystal ball question for both of you to close out the conversation. Russ, you told us what deals you were targeting, but how's the asset type sort of brought, like interest focus broadened since IT took over Thora?
Well, it was always part of the strategy from day one to broaden, past just rotorcraft into fixed wing, but into the areas of fixed wing that was still represented an appropriate return for the risk, which I believe the commercial aircraft market does not represent and hasn't done for a long time. It's basically any fixed wing aircraft that is liquid and investment worthy, however you want to measure that, that's performing mission critical services. I mentioned earlier fixed wing EMS. There's a global market of EMS fixed wing aircraft. So that would include some of the corporate jet types, to a lesser extent, and aging out, the Learjets, the Pilatus aircraft, 12 and 24, the King Airs, these kind of aircraft. We like the Dash 8s and the ATRs and we'll consider any aircraft. Like, for example, people might consider a CRJ 200LR being an aged out aircraft, but there are fleets of those on long-term package freight contracts with DHL and the likes, and FedEx. Those are stellar deals. So really, we've always considered any helicopter type, because we don't look just at the metal alone. We look at what contract it's on with who and what the cash flows are like, and can we mitigate all the risks? And can we mitigate the fact that it might be an out of production aircraft? So we have done out of production aircraft types because we've been able to mitigate that risk by being maybe fully amortized or having a long-term contract with a solid or a sovereign entity where it was more of a cash flow deal than an asset deal. So really, we've always considered any aircraft type, and we still will, because we'll look at every aspect of the deal, and if we can mitigate the risk and justify it and it makes sense, we'll do it.
Got it. All right. You've both experienced boom and bust cycles firsthand. The aviation market's cyclical. The rotary market's no exception. Can you table your crystal balls, gents, and muster your decades of experience and let us know what you see for 26 and also for 2030? So give us your 1-year outlook and your 5-year outlook.
I think Russell should go first on that.
And obviously you have two very different prisms, right? So,
oh gosh, I think 1-year outlook is probably continued resilience of aircraft values and lease rates. I think I do have concern that if more capital and more players move into the market, that there'll be downward pressure on lease rates beyond that. And then 5 years, I think you could argue that there's a kind of a 10-ish year cycle, and 5 years we're pushing up against that, I think. So there's that to consider. So I would expect beyond beyond 1 year for there to be a sort of a cooling down, without wanting to be more specific than that.
Yeah,
John.
I think for me, I agree with that. But I think I really never like this crystal ball things. It's just so hard to provide any value with any comment on it, because there's so many variables that could happen, and as well as the markets seemingly are all connected in a way, right? So we're sitting here talking about helicopters, but
It's an opinion, right?
what happens in fixed wing also bleeds over, again, from that perspective, because if there's disruption in certain markets, nonetheless, even if helicopter usage is strong, right, and there's a lot of replacement demand for helicopters, and those will need to be financed and things like that. I think over 50% of the new deliveries in the next 10 years, I think, are going to be replacement. But absent, I'm just hoping for stability, right? So I really can't forecast anything with accuracy. But if I'm just hoping that there's not any kind of disruption in lending, commercial lending, commercial aircraft lending, and things like that. So apologies, I can't provide anything further than that, because I think it's just too difficult. But I think, as Russell pointed out, I think the next, I don't know, 2.5 years, I would expect just stability, right? We have stability in our government at this point in time, relatively speaking. We have stability in the markets, I think. So, but things could change, and so that's why it's really hard to forecast. But I'm optimistic. I think that's the one signal is I'm optimistic. And I think there are plenty of people. There's plenty of money out there. There's plenty of private money that really wants to get to work, and banks also. I mean, you just look what East West did, right? They decided that aerospace and defense was something to get into, and other banks also have come into the market in terms of aviation lending. So those are pretty good signals, I would say, for optimism.
Yeah, well, thank you very much. I appreciate you taking a stab at making this prognostic, and really great effort to you both. So thank you, and also thank you for your insights, John Heskin, Russell, Christopher, and thank you to our moderators and panelists, and to everyone joining us live or watching via replay. Aero Asset continues to publish a Heli Market Trends report quarterly. You can download the report, the latest edition, at aeroasset.com/report. And we look forward to welcoming you to our next Heli Market Trends Live Roundtable in January. And until then, thank you very much for joining, and happy holidays if you're going. See you next time.